Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Darin Davis. He has over 25 years of real estate experience and has been involved in over $1 billion of debt and equity transactions as both a sponsor and an LP. So thank you so much for coming on the show today, Darin.
And Charles, thanks for having me. I'm excited to talk to you guys today.
Yeah, no, it's great. You have a very interesting story, which I'd like you to get into, but it's just awesome to have different people on. You have a number of different strategies that your firm employs that I don't think our listeners have really heard too much about, and so it'd be a great learning experience for them and also myself.
Yeah, no, I'm looking forward to it. I guess being older and having gray hair like I have, I've got a lot of stories, so we don't want to go down the whole path, but I do have a couple that I really want to share with people, like how I kind of really got started in this, and then what the power of passive income did for me. Pretty good story. Want to share that, but where would you like to start, and we'll get going.
Yeah, so just to give us a little background of yourself, both personally and professionally, prior to getting involved in real estate, and then we can go into you, or you can go into your story about how passive income has become an instrumental part of your life.
Yeah, and kind of what we're doing today as a company too. I'm probably not a lot different with my kind of age group. When I got out of college, the first thing I did, I had a business degree, and I went into sales and marketing. So I did a lot of. I was in sales, and I got into financial services at American Express, and then I noticed all my friends were getting into high tech, and I go, I got to learn about this high tech stuff. So I flipped over and started selling software, and had a really good career. I guess selling software, you didn't really have to be a techie; you just had to solve business problems. So, and that was what I did. But after 15 years of literally working Monday through Friday on an airplane, not a lot of social life, I kind of stepped back and I said, man, I'm not in control. I am working for somebody 24/7. And it felt like that. And then my father unexpectedly passed. And I think that's when I said, I don't know what I'm going to do, but I'm going to do something different. So the mindset had started. All right. And I literally am driving down the road. I was in San Francisco at the time, working for Yahoo, driving down to San Jose. And I'm an AM radio guy listening to, that's the only thing we had for education back then in the car. There was nothing else out there really. But I heard this guy talking on this radio, and it was an hour-long interview. And I was just fascinated by what he was saying on the radio. And I'm going like, I got to figure out who this guy is. So I pulled into the parking lot, and there were still 10 or 15 minutes left on the radio show. And I sat in my car and listened to the very end. And sure enough, it was Robert Kiyosaki in 1999 or 98 talking about Rich Dad, Poor Dad, that whole concept. And I go, what is this? So I literally that weekend went and I tracked down a book because there was no internet. There was nothing really, to find it. And I read it, and I don't even really remember what it did to me, but it flipped a switch, and I did a 180. So my mindset did a 180. And then at that time I said, okay, maybe it's real estate, maybe, but it didn't really matter what it was. It was the mindset that I switched. And that started the whole thing in 2001. I think I left, I left San Francisco. We moved back to Texas and started real estate. And that's what got me going. I felt like I was in control. I'll tell you that.
So you kind of escaped the whole .com explosion for the most part, right?
No, I was right in the middle of it. No, I was there. I'm not going to go through the numbers, but I tell you, my valuation of my Yahoo stock was up here, and quickly it went down to here. And I think that was a huge bubble burst for me. And that's, it was just a lot of things were happening, and I just said, you know what, I got to do something different. And I literally switched. I mean, I jumped in with both feet. I didn't pause. I said, go.
Yeah. The only person I think that navigated anywhere was Mark Cuban, who sold out to Yahoo, and he's like right at the right time. And yeah.
I've got a story about that too. I was sitting, and I'll be really quick. I was sitting in the broadcast.com offices interviewing for the position that I took at Yahoo. And Mark walks in, and I'm interviewing with their VP of sales, and he just looks at me, and he looks at the guy I'm interviewing with, who's a friend now. And he says, hey, you got to get him out of here, him being me. And my friend's going, well, why? And he goes, just get him out of here. We got something. And so sure enough, as I'm walking out the door in my final interview to take the position, in comes Jerry Yang, the chief Yahoo, to announce that Yahoo had just bought broadcast.com. Yeah. So I woulda, coulda, shoulda. I was that close to being, you know. So, but anyway, quick little story. Yeah. So, yeah, Mark did good.
Yeah, yeah. See, so tell us about how you got involved with real estate, because obviously people they start one place in real estate, and it's usually not where they end up after so many years of kind of learning with any type of business. Where did you start in real estate? How did you get involved, and how does that kind of pave the way to where you are now?
Yeah, and I kind of want the listeners to really think about what I'm about to say, because I see so many people, they read a book, they study, they talk about it, but they don't execute. And I got to tell you, reading books are good, and you're going to learn something on that. But until you actually go out and do it, you're not going to feel the pains and learn from the experiences. So especially young people, I tell them, I say, guys, you've got to take some, and I call it chances because it kind of is in the beginning. But you're not going to win every single thing, but you're going to learn everything. You're going to learn a lot. But what I did, I mean, not really different. I started off with, three, maybe four. I'm going to say three single family homes because I didn't know anything. I didn't know how to get a loan. I didn't know what a syndication was. I didn't know anything. All I had was, kind of an idea of what I've read in a couple of books, but I said, I got to go try this. So did a few single family homes, realized that that's not the path I wanted to continue going down. And I just started really working the network here in Austin. And I was introduced, I give this guy a ton of credit, but I was introduced to a gentleman that was doing exactly what I wanted to do. And that was syndicating and raising capital. But he was doing it for retail strip centers, kind of Class B retail strip centers. And I pretty much I didn't beg him, but I pleaded with him. I said, I can raise some money. Let me in. Show me how you're doing it. I want to learn. I want to learn. And he did. And we ended up doing 13 retail strip centers over the course of the next 4 years. And I didn't even know what a syndication was, but I learned, and I started off my first deal. I think I raised, 120 grand. I thought I'd hit the lottery. And then it was 250. Then it was 350, so, and it was really friends and family. And so I was in that group, but I learned the structure of syndication. And what happened on that is that all I did to find him is I kept networking. I kept asking questions. I kept just pushing. Because remember, I told you, I jumped in with both feet. So I had a wife and I had one little kid there and one on the way. But I started off doing syndications and I just learned. I did a lot of learning. And then from there, I thought, all right, I can do this on my own. Well, in 2007 ish, okay, I said, you know what? I want to go bigger. All right. And I want to do multifamily because I figured out the math and the metrics and everything that was working. And sure enough, I did my first multifamily. And maybe not a lot of listeners can remember this, but 2007, 8, and 9 were probably the worst time ever to do development, especially your first one. But we did. And there's a story behind that. We did it. It was a huge success, but the hardest thing I'd ever done to date, and ended up being one of our best assets we ever had. Cash flowed. Investors loved it, and that really launched the company because we did so well on that one. And then we just carried that forward for the next decade, and here we are today.
How are you able to get financing during that time? That was the one thing I was involved. I bought my first multifamily in '06, and it just, not that it was just a straight blood bath, but the thing is, there was no lending, like literally no lending. Even private money lenders were like, whatever you paid for something, I'll lend you like 50% on it. You know what I mean? Like not, there's no market value. There's just like, it's very, very low. I had one bank give me a 15%. They offered to give me a 15% loan to value loan that I'd worked with for 10
Really?
years. And you're just like, it's just like insane. Like, you're just like, there's nothing like that. So it's just like, how did you get financing?
Well, okay, so and here's the story, and this is why I really stress people, man. Just you've got to ask questions. So sure enough, I have a very large, well-known lender who is going to give me. I have a term sheet, okay, and that's pretty. When you get a term sheet, yeah, it's pretty good. Well, things were getting a little salty there, and sure enough, I'm talking to them, and they're acting like, you know what, yeah, we'll be fine. We'll be fine. Well, sure enough, a couple weeks later, I get a letter, no phone call, no nothing. We're going out of business. Okay. And yeah. And I said, but no, no, no. I had like 700 grand into this deal already personally. Okay. It was a whole lot of money for me at the time. And I said, but I have a term sheet. We're going forward. They said, no, we're not. We're shutting the doors. I had no money. So I'm sitting here with a piece of raw land, architect, engineer, due diligence, all into it. And I go, nobody's lending. So I kept literally asking people, what do I do? What do I do? And a guy that I met said, have you ever heard of HUD? And I go, yeah, Section 8. That's the first thing that came to my mind. And they said, no, no, no. This is where HUD will insure the loan from the lender. So I said, okay, tell me more. Well, after, a year of construction virtually stopping or acquisition stopping, and you saw it firsthand as well, HUD became the preferred tool to use to get lending because lenders said, wait, if HUD will insure the loan, then I'll make the loan to this guy. Now, I still had to go through underwriting and everything, but all of a sudden I learned about HUD financing or HUD loans. And for people that were back then, I mean, HUD was the Cinderella of the party because nobody else was lending. So if you could get a HUD insured loan, and the terms were really good, it wasn't easy to get, the loan, but the terms were really good. And we were one of the only projects in the whole city of Austin come out of the ground in 2009. Uh, and it was just because the lending was tough, but the HUD programs were working for people, and that's how deals got done back there for a couple of years.
Oh, yeah, it was. We were doing some house flipping at that point too, and it had everything had to be able to. When we looked at it, had to be able to be approved for FHA. You know what I mean? Like if it didn't, if there was any question, I remember one time we were walking this place and like the stairs were like a little bit off, and we're like, I don't think this is going to get approved. We're like, nope, out here, because it was the only thing that was lending. You know what I mean? Like you had to be
Yeah.
very very aware of that, and it was amazing that if you bought anything 5+ units, which you can't get FHA for. I mean, it was just something that was like, those things would be like half the price of like a 3 family or 4. You know what I mean? It was just because there's the financing ran the whole thing. So it was just the government was the only backstop there to do any deals and keep something going, which most of it stopped.
Well, and a little sidebar on this is that the I wasn't an experienced developer, and so HUD was a little kind of wait a second. But what we ended up doing to strengthen our ask on this is that I partnered with the city of Austin, and we implemented some affordable housing. So when HUD saw, oh, they've got the city involved with them, they've got some affordability, which we really like. Now that raised the bar. Okay. So they said, wait, okay, this guy may not be the most experienced apartment guy, like zero to date, so, but he's in a growth market. He's got the city of Austin backing him. He's got grant money from the city of Austin. He's going with some deep affordability. We like that profile, and so we're going to back that loan, and that's how we did it. So I mean, I will tell your audience this. My back was up against the wall, so we had to ask questions. We had to be resourceful. I had a guy ask me one time, he goes, well, tell me about your underwriting on the deal. I said, have you ever had a gun pointed at your head? That was my underwriting. Okay. I go, there was no underwriting. You figured out how to survive, because if I had to underwrite that, nobody would, I mean, people were going like, well, this doesn't make sense, but we did it. It worked, successful, but we were just super resourceful. We got the city involved. We put the affordability component. We got HUD involved, and to this date, it's still one of the best investments we've ever done.
Do you have money sitting in the stock market and you're worried about it? Or worse, you have money sitting at the bank, not keeping up with inflation? My name is Charles Carillo, founder and managing partner of Harborside Partners. And since 2006, I've been investing my money and my family's money into income producing properties. These are real assets, real properties with real addresses that produce real cash flow. At Harborside Partners, we provide passive investors who love real estate with a turnkey investing solution. If you want to put your money to work in real estate but can't find deals, don't have the time to get funding, and the last thing that productive people want to do is manage real estate. We find the deals, we fund the deals, and we manage the tenants, the termites, and the properties. Partner with us at investwithharborside.com. That's investwithharborside.com. Go to investwithharborside.com. If you love real estate, you like the idea of passive income, and believe that income producing properties will appreciate over time, go to investwithharborside.com. That's investwithharborside.com. So this is the HUD Affordability P3 strategy. Is that what it is? Where you're partnering with a public?
Yeah. So, and this is interesting. And I think this has, for your audience, I think this has a lot of runway for a long period of time. I mean, there's a housing shortage period. There's going to be. I don't think we can catch up unless Elon Musk figures out some way to put 1 million homes on the planet tomorrow. It's just going to take a while. But what's happening, like here in the state of Texas and Florida, where we do some business also, is the working with the local governments where you're providing some affordability, and in return, they will give you some concessions. And what's happening here in the state of Texas is that you're getting property tax concessions or reductions or elimination for depending on how deep and affordable. Now, from an investor standpoint, here's something to really think about. And if you're talking with a sponsor that does these programs, if you think about your expenses, and today, insurance and property taxes are just off the chart, especially here in Texas. We have, between tornadoes in the north and the Gulf of Mexico and hurricanes in the south, Texas is in an interesting spot. But so we're managing through the insurance, but we can eliminate the property taxes, and that's one of our biggest expenses. So if we can cap that at zero, which we do, and we have 50% of the units are affordable to some degree. Well, think about this: if your median family income rises 3-4% a year over year, well, think about that spread between flat taxes at zero and your revenues just keep ticking up. Now, it's not great in the first 3 years. It's kind of it's good. But boy, you hit year 5, 6, and 7, and that spread gets bigger, bigger, bigger. And that's how you're rewarded as the investor group or the sponsor group, is that affordability really starts kicking in from a return to the investors several years later, but it's really strong.
So other than the ability of, there's some great terms that come with HUD debt. Can you just give us like a little overview of some of the pros and cons of obtaining HUD financing, whether this is for ground up development and or for financing acquisitions?
Yeah. Well, first thing I will tell you, it's not easy to qualify on your first deal. Okay. So finding out, there are groups out there that are HUD centric or HUD focused. So understanding sponsors that are looking for equity in the HUD world, it's a great way to learn about how HUD is structured. So if you're ever, wanting to get into it as a sponsor, it's a little hard, but once you're in, you're in. All right. The other thing is from the LP investor. Here's some of the key metrics on this one. It's typically an 80-20 leverage. So, most banks are in the, 70-ish range, 75. So the deals, when you're getting HUD financing and you're getting 80, 81, 82% leverage in a more normal market, that's pretty strong. And, you're getting that at 4.5%, 5%. That helps the deal metrics quite a bit. The other thing is that on a construction new development, you can get a 40-year AM. All right. So going from a 30-year to 40 or 20 to 40, that really improves your cash flow. It really helps, from an investor return. On an acquisition of a HUD, you can get 35-year AM. So it's pretty strong. Now, these things are there's the downside to them is once you're in them, you don't really put HUD debt on it unless you're planning on holding it for 5+ years, because there is a yield maintenance expense or a prepayment penalty, and that burns off after years. But in the first year, it can be as high as 10% in the first year. 10, 9, 8, something like that. So there's some pros and cons on it, but it's when you look at your leverage and you look at your amortization schedule, and you typically have a little bit lower rate, it really can get really attractive, especially when the leverage piece comes in today's market. HUD is back to the 2008, 9, 10, where HUD's kind of the darling of the party right now. A lot of people are looking for that HUD financing.
Yeah, the couple things I've heard too about it, and you can correct me if I'm wrong, is that number one, it takes a while to prepare to get the deal done, and then number two is I hear that you can only make distributions to your investors twice a year. Is that correct?
Good, very good questions. Yeah, and let's go to the first one. The approval process can be lengthy. Okay, so you don't really see acquisitions using HUD financing, because if there's a deal out there for sale, it's really rare when the seller is going to go, oh, it takes you 6 months to get approved with a HUD. Well, I'm not waiting 6 months. Okay, now there are some scenarios that you can do that. Uh, Getting approved on the construction can take 6 to 9 months. So depending on, your carry cost and what you're doing now, but again, the terms are really good. But if you have the ability to carry through that, best case scenario, 5 months, probably 9 months, it can be a very attractive deal. Now, the distributions, um, they used to be twice a year, every 6 months. That has changed. It is more frequent now. And I wish I knew the frequency, because we have sold all of our HUD product in the past. We think we have. Well, I take that back. We have one product that just finished construction under HUD, but the distributions I know at least are quarterly now, and they may have gone to every 2 months. Don't hold me to that, but it is far more frequent than twice a year.
Okay, great. As we're kind of one more question about from moving on from development was that development is, I mean, there's a lot of moving parts, and what are some of the main factors developers must be aware of or pay strict attention to when they're developing a project, maybe specifically a multifamily project?
Yeah. So just for clarity, we are not a development shop. We'll co-develop and we'll GP sometimes, but we're primarily LP equity. So we provide the equity, usually 50% to 90% of the equity, depending on the project. So, but from a development perspective, the last 10, 11 years prior to the last year and a half, there's been such a growth mode, here in the state of Texas. Just our supply was incredibly low. The net migration was incredibly high. The jobs are coming in. We just had, massive amounts of people relocating here over the last 10 to 12 years. We're still leading the country in job creation and net migration, but not at the pace we were for, the past decade, on that. But for developers, the things that are super important if you're an LP investor looking to invest, you really want to make sure that all of their entitlements are complete. Okay, because going through an entitlement process, and that's your water, your wastewater, your utilities, your zoning, all of that. If you're talking to a developer and you're looking to fund into a deal, making sure that all of the entitlements are done is super important, because if it's not, one small thing in a government scenario hold the project back months, if not a year or more, and then you're in the dead zone, and then there's nothing you can do, and the entitlement process is a big deal. That would be the number one thing. Make sure that your sponsor has all of the entitlements. And the other thing is, development is not easy. So really, when you're talking to a sponsor who does development, really check their track record. Make sure they've had successful projects in the past.
No, that's a lot of great information there. Before we get into your passive investing story, there's one other strategy that your firm employs that really haven't spoken too much about on our podcast here, and that is with preferred equity. And can you give us like an overview of what preferred equity is and how your firm is able to offer that and work with that with your investors and with some of the deals you do?
Yeah, and I love it. It is such a great tool, especially for LP investors today. But in the past, 10, 15 years, we've all lived in a world where you have your senior debt, your bank loan, okay, then you had common equity. So you had your capital stack was two components, common equity and debt. Well, what's happened is in the development world, especially, that I'm very familiar with, a lot of development loans were taken out 3 or 4 years ago, and that 3.5%, 4% floating rate. Well, those rates have now climbed up to 8.5%, even 9%. And what's happened is a lot of the interest reserves have been utilized. A lot of the contingency money's been utilized because you've had this perfect storm where interest rates are high, leverage is low, valuations are lower, rents are flat, supply is a little high right now, and the developers have great projects. They're in great locations in great areas. They need what they call rescue capital, or they need some high octane oxygen, capital. But what pref equity is it fills a gap, and where it comes in is it's usually 10% of the capital stack, maybe 15. It's never more than the common equity because the common equity sits behind the pref equity. Now, the pref equity is pretty straightforward. It comes in, it fills that gap of that capital that's needed for the project to get complete, leased up, and stabilized. And these projects are anywhere from 3 to 8 million. They come in, and the pref equity gets a return that pays out quarterly. So if I'm putting pref equity in the deal, I'm not getting the upside that the common equity might get, but I'm getting a finite return at a finite date. So it feels like kind of a second loan on a home or mortgage. You get a higher rate. Our investors are getting anywhere between 11 and 13, 14% on this, but it's secured by the asset and it sits in front of the common equity. So it gets fully paid before the common equity does, and it's coterminous with the senior debt. So when the loan matures and the sponsor or developer needs to get permanent financing or sells it, our capital and any amounts that have not been returned to us get fully paid before any of the common equity gets paid. So we have that safety net behind us. So, and it's really good because it's short-term money. You're kind of sitting on the sidelines waiting for that next bigger opportunity, but you're not sitting there holding cash doing nothing. And pref equity deals are 18 months to 30 months. They're not long term, because when the loan matures, you're out. And that's what's been really our investors have been very intrigued by, hey, it's short term, it's secure, it cash flows, it's in a great asset. We like it. Let's put the money to work.
Yeah, so that's great. So for example, for listeners, if you had senior debt, first mortgage being say 65% loan to value, then you had Darin come in at 15%, so he's making up between 65 and 80%. That's coming on out of pref equity, and then you have your common equity, which is your investors. So pretty much, they're secure unless more than 20% is cut off the top and then goes foreclosed, something like this. But they're getting a return higher than the senior debt, and they're getting a fixed return, which may be higher than common equity today. You know what I mean?
No,
Because stuff's getting
you're,
haircuts.
you bring up a good point. We're still underwriting development deals, and we're not seeing anything that pencils into the teens at all. I mean, we're seeing 10, 11, 12 for the common equity, and we're just going, why would we go do common equity at 12 when I can get 12 on a preferred from a project that's already in the works that maybe is 90% complete or is stable or is leasing up right now. So that's a good point. I mean, there's not a lot of common equity that actually makes sense. Now there's going to be a unicorn out there. I'm not telling people to, say no, but it's going to be, 1 in 10 or 1 in 20.
So, Darren, I want to you have a story about passive income that is very personal, and if you don't mind sharing it, it tells about go into exactly how it affected you and your family.
Yeah, I couldn't tell this story a few years ago, but I can today, and it's pretty powerful. And I'll tell you, I'm going to backtrack a little bit. When I heard that radio program in California, and it was Rich Dad Poor Dad, it just shifted the mind. And of course, my girlfriend at the time, to be my wife, I just was excited. I said, you gotta read this book. You gotta read it. She read it and she goes, I get it. So I had a business partner also. So that was good. But we had both grown up in a paycheck to paycheck kind of households. And we both were like, we don't want to be that as we get older. What can we do different? And so we said, we're going to do this. And we I left my job, she left her job, and we started this. But we started building this real estate passive income strictly to not have to work. And we both wanted to spend time with our kids because both of us were latchkey kids growing up, you know. And for people who don't know what that means, that's, we came home to an empty house I got off the school bus and came home and there was no parents there, and she had the same thing. We just wanted to change all that. So we said, we're going to build this passive income. Well, we spent 10 years, kind of testing what model worked the best for us. And sure enough, the multifamily that we started in 2009 was really where it really started. But we started building this passive cash flow from multiple real estate projects, and things started going pretty well. And we're going like, wow, we do this for 10 more years, we could probably be set, And so, but, God has a strange way or the world has a strange way of throwing you some curveballs. And my wife got diagnosed with cancer. And by the time we really discovered what was ailing her, she was already at stage 4. And we had 2 young children, and um, they gave her 2 months to 6 months to live. And it was like, God dang it, what do we do? Not even thinking about finances at the time. It was all about how do we prolong her life? What do we do? So we literally, and this is where, this nonprofit that we just established a couple of years ago called Never Quit. She just kind of looked at me and said, you know what? We're going to figure this out, and we're going to figure it out. Fast forward, um, she lived for another 4 years, 4.5 years. So she beat all the odds. All right. But what happened in that 4 or 5 years is I spent a ton of time with her um, for treatments, and we were going from Austin to Houston at MD Anderson, which I give them a ton of credit. But we were not constrained to the insurance program or the finances because we had spent 10 years building passive cash flow. So I was able to step back out of work and not work full time, take care of her, help raise our 2 small children. And I literally could not have done that if we didn't have passive cash flow. And I think most people know, medical expenses are the number one reason people go bankrupt. Okay. I mean, number one. We saw it firsthand. We were just so fortunate that we had, done what we had did, not knowing how we were going to need that or use that. But there was a couple that were pretty much on the same treatment schedule time that we were, and both of them were employees. And I saw them getting treatment based on what the insurance company said and not what the doctors wanted to. But they didn't have the resources to go pay for the program that the doctors wanted to do. And I saw just gradually over the course of a year, just things started imploding on them. And I think they looked at us and going like, wow, these people seem not to have the same issues that we have. And we didn't. And that passive cash flow literally saved my family's lives. I mean, it hands down. Now, fast forward to today, here we are 5 years later, and it continues to grow, and it just keeps continuing to grow. But you know, everybody is going to face a life crisis at some point. I mean, 10% of the people on this that are listening to this podcast have gone through the same thing I've gone through in some form or fashion. And by the time they're 60 years old, it's going to be 50%. So the probability that it's going to happen to you is fairly high. And the best thing you can do is, it may not be the perfect plan, but plan, and find ways to get cash flow, find ways to get multiple streams of income that don't require your time. Because I can tell you firsthand, if we had not done that, my life would be drastically different today. Drastically different. My kids' life would be drastically different.
Yeah, that's a very powerful story. Happened to my uncle 2008, and I remember he had a business, insurance business he had like set like a business. He didn't really have to do anything with it. And when it happened to him, his family could be with him. It wasn't something, just like you were saying. It was one last thing they had to worry about, and he was able to spend more time with his family and travel and do the things he wanted to do in his last months and days. So it's powerful. I mean, it's a powerful thing. And like you said, most people will be affected by it for years to come, but, or know someone that has, but it's also one of the things is that, you're going to go through one way or another, something having that consistent income, something you're generating something outside of your retirement account and your job. You know what I mean? Another income stream that's coming. It's very powerful. You know what I mean? No matter how small it is, it can help you.
Yeah, and it doesn't have to be real estate too. I mean, there's so many. I mean, for me, back 20, 25 years ago, there wasn't a lot of ways to generate passive income. I mean, there was, but real estate was the go-to. I mean, today, if I was starting all over, I don't know that I would 100% be all in on real estate. I would probably be doing two or three different things, just understanding market dynamics and diversification and. But there's opportunities out there. So I think for people today, it is far easier to do that. You just got to do it. You just absolutely got to do it.
So, Darin, thank you so much for sharing about your business and also about your personal life. And how can our listeners learn more about you, your company, what you guys do, and possibly connect with you?
Yeah. Do you know who Carl Rove is? You know that
Yeah,
guy
yeah.
on.
The
When he takes
bushes.
his little whiteboard and he goes, puts it up here and writes up on it. Uh, so it's Club Capital .co, clubcapital.co. Okay. Yeah. And I'll tell you there's a pref equity 101. It just gives you some foundational stuff about pref equity. There's another document on there. I mean, there's a lot of resources, but I think that one, since we talked about pref equity, and I think something else is super important. I've seen this here. There's been a lot of syndicators in our local market that started 5 years ago, 6 years ago, that are pretty much out of business today. They didn't have the experience or plan correctly, whatever. We also have a document on there on, I think, the top 10 questions you should ask every potential sponsor that you may invest. Pick those up, and those two things alone can really give you a lot of insight on pref equity and sponsor opportunities.
Yeah. The one last thing on the pref equity is that I find out that most pref equity is coming a lot or partially from family offices. So it's something that they're doing it for a reason. This is smart money. So it's something that start thinking more about your finances like that. I think pref equity is another tool you can put in your toolbox for building wealth.
That is so true. I got an email this morning before we got on here, a family office out of Chicago wanting to set up a call with us next week. Yeah, they want to be in Texas and they want to get in the door.
Right. Yeah. They're looking for exposure to it. They're looking for a return that's higher than what they would be getting elsewhere. However, they don't want all the risk of coming on in the common equity side. So it's a very interesting, very important piece, especially now, and it's not going away anytime soon. Thank you very much. I will put all those links into the show notes, and I'm looking forward to connecting with you here in the near future, hopefully.
Man, I'd love to reconnect in about 6 months and give you an update on what pref equity is doing. And I appreciate it, Charles. Thank you so much.
Thank you. Have a great rest of your day.
All right, you too. Bye-bye.
Hi guys, it's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars LLC exclusively.